Coming. For those who are joining for the first time, let me give a quick introduction. Amit has investment management experience for about more than 2.5 decades, and pretty much understands the journey all the way from idea generation to attribution. And if you find it a little bit complex to understand, we'll describe it in detail. That's why we have Amit here with us today. And we will also talk about a little bit about the investment management process and the journey overall. So thank you, Amit. I think rather than making it a monologue, I think it'll be best if people hear directly from you. As everybody knows, you are known for your simplicity in terms of your lifestyle, not just your lifestyle, but also in terms of your ability to make complex ideas simple. So thank you very much for joining. And we'll probably just start with very fundamental question: what is investment management?
Right. Thanks, Ashutosh, first of all, for inviting me to the conversation today. So, like investment management, if you take the two words, investment is related to how do you use your money to generate returns, and management is managing that money. So, in a sense, investment management is the art of how do you generate returns on the money that you put in various markets.
Okay, that's interesting. So you're saying how do you put in money, but how do I interpret you here? So talk a little bit about the players in this game, and when you're saying how do you invest money, what does that really mean?
Okay, so like investment management is again of like financial market, and for any market, there are three players which I feel. One is the consumer who actually is buying the product, a manufacturer who's creating the product, and in most instances, there is an intermediary in between the market where both of them meet and buy and sell their product. The customer has a need, manufacturer creates a product to you fulfill that need, and they come together in that market to buy. To further elaborate, a customer can be an individual or an institution. An individual, it could be people like you and me, laymen, who have small amounts of money on which they want to make more money. They could invest into a bank, create an FD, or go into capital markets. Or it could be more sophisticated investors, people like Rakesh Jhunjhunwala or Warren Buffett of the world, who have a very big understanding of the market and themselves can put in huge amounts of money. The other customers could be institutions who again have large sums of money. It could be big companies like who need to manage the pension money of their employees. Like it could be sovereign funds who have, say, oil-rich companies who have made a huge amount of countries made a big amount of fund on which they want to serve their citizens, or could even be charities or things like those, even university endowments who want to invest money and generate returns on their portfolio.
So that's very interesting, but help me understand this. When you spoke about the individual investors, and you lot of see, for example, you took like the name of Warren Buffett and me in like one breath, which is very good to hear. But more from an investment management function, in a professional sense, are there like distinctions in terms of how they operate, what they do versus, for example, if I have to buy something, or typically, my agent or somebody would be helping me out, or sometimes, to be honest, I just look at something on the TV and just buy it. Where does this, where does that distinction come from? If let's say somebody putting in 5 crores, or let's say 20 million, versus somebody like me who's just putting in, let's say, 10,000
Okay.
rupees a month.
I think this is where the role of that manufacturer I talked about and the intermediary comes in. Like a manufacturer, in a sense, could be an asset management company,
Right.
which creates a mutual fund product, which is nothing but the aggregation of small amounts of money from retail investors, which they take from them and then invest them into the different capital markets based on their investment mandates. For other high net worth clients, there could be things like hedge funds who probably don't fall under the same regulation. They can again pool in money from those big investors and invest it back into different markets. Or further going up, there could be portfolio management services where some of these big sell side companies, investment banks, who offer specialized one-to-one investment services of many of these high net worth clients.
Okay,
Can
that's
invest on their
interesting. There's
behalf.
a lot to unpack here. You spoke about the institutional investors, you spoke about individuals, some of the intermediaries. Maybe you can take this call. Okay, that's interesting. but there's a lot to take in here, and I think let me just unpack some of the things that you spoke about, just for the sake of our audience. You spoke about institutional investors, you spoke about individuals who are putting in large amount of money, the intermediaries and so on. So just to put this in a perspective, can you just give a picture of who are the key players in this game, and how is this like broadly structured? If I consider my retail investors, some of the institutions, some of the high network individuals, HNIs, as you were referring them, just talk about players a little bit in this landscape.
Okay, so I think broadly the financial markets are typically classified what we call as buy side and the sell side. The buy side has players like asset management firms like Fidelity, Schroders of the world, hedge funds, it could be private investment companies. And on the sell side, you have the big investment banks.
Right.
One of the major role that they play is brokers and in the market through which many of these buy side or the retail investors and go and invest into those markets. If you go further broader, it could be even like insurance firms or banks, commercial banks who also offer those products through which the customers like retail or even institutions can go and invest in those markets. So these are the key players. But aside from that, there's a huge amount of regulation that happens, right? For each of these different markets, you have specific regulators in each of those geographies. Say you have SEBI, which regulates the capital markets in India, the FCA in UK, and similarly, regulators in each of these big markets who play a big role in keeping the sanctity of the markets, protecting the investors, the customers, and also ensuring all of these transactions happen smoothly. They lay down the processes on which the whole system runs.
Okay. So basically, when my agent is calling me, he is on the sell side. I'm the end consumer who's buying a mutual fund, or let's just talk through his recommendation. And that mutual fund might then have been created by somebody who you're saying a buy side company. Okay. Understood. And in terms of, these investments that we are talking about, and I think what we are so far talking about, it seems like we're still talking a lot in terms of the equities market. But then we see, things like Shark Tanks and Dragon's Den and whatnot. Where does that fit in this overall picture?
Okay, so when we talk about asset classes, I think we first need to understand what is an asset class. Is anything, or a security like we even call it, is anything which has a value, right, can be traded in the market. For a very common person, it's shares which trade on an exchange, and for another extreme, it could be even paintings that are sold on the markets through
the NFTs and stuff like that.
So again, asset classes broadly you can classify based on the markets they operate into two. One are their listed markets, or what we call as exchange traded products. Another are private assets.
Right.
Exchange traded products could be an equity, like you said, it's shares. Again, there's a lot of classification within equity. Then you also have what we typically call as fixed income. Many people tend to equate fixed income just as fixed deposit they do in the bank, but yeah, fixed income market is much broader than that. In fact, it's much bigger in terms of size than the equity market. Includes corporate bonds, government bonds, and a lot of what we call as OTC, over the trade counter, which is only dealt by institutions.
Right.
And then within private assets, I think there is a huge market, what we are also commonly referring as alternative assets, which is emerging. Private assets, again, you have private equity, where you invest into companies which are still not listed, or you have private credit, even real estate, and all of those things that we talked about.
So all the cryptocurrencies and
all of them, I think I will put them in alternative assets class at the moment, because they're still not become mainstream. And even within private equity, there are various ways. Like if you see how a firm or an organization evolves, or typically you will see somebody say starting a company in their garage, right? They will need some very startup money.
Yes.
Typically you have what we call them as angel investors, because there is a maximum risk. Yeah. I think one of the key principle of investment that shapes the market is risk return, right? If you want to generate higher returns on your investment, you need to take higher risk. So typically, like I talked about, this whole cycle of angel investors, till venture capitalist to private equity, and then public investment. At each different stages, there is a different risk. Angel investing, the investor is carrying the maximum risk. Right. So again, the risk profile determines a lot on what kind of people who will go and want to become an angel investor or a private equity investor or a public investor.
But why would somebody put in money if somebody is more risky, but somebody's got less risk associated with this? How does one decide whether to invest in, at what stage of the process?
I think a lot depends, like I initially talked about customers. It's about the risk taking capability of those people who have that money, right?
Right.
Somebody say who has and that risk taking capacity doesn't depend on the net worth of an individual, right? It all, if you see, have read investment books, it all depends on the internal psychology of a person, how much risk they want to take.
Yeah.
I mean, the highest risk is a person who actually wants to go and start his own company, right? He doesn't have anything. And
So I'm in that category.
yeah, it's like I'm putting, like you are putting your own money to start your, right?
Yes.
You're not going to any of these people I
Investors,
talked about.
yeah.
And based on that, it's about that risk-taking capacity of that person, which determines what the kind of, when would they enter in the investment cycle.
Yes.
And that depends, like I said, a lot of the psychology of the person, how their mental makeup is done. There's a huge amount of literature available to determine the riskiness. Right. But again, the very basic fundamental of financial management, investment management is to generate higher returns, you take higher risk. And the risk can take you upwards as well as downwards.
Right.
But it's the risk-bearing capacity as an individual or as an institution that determines. So if I take an example of a pension fund, which is managing the pension money of the individual, they probably may not take that amount of risk.
Right.
Because you're compromising on the retirement of the people. But a venture capitalist working in Silicon Valley, he has investors who want to invest in technology, might incline to invest into new startups. They know maybe 9 out of 10 of the investment would fail, but they'll probably recover in the 10th investment.
That's interesting. You spoke about investing in a technology company, but technology company themselves are from a business perspective one side of the story, but even to run investment management functions or the various aspects of it, I think there is probably a huge role, like any other industry, that technology plays. So talk a little bit about the role of technology in the investment management function and how it's changed over a period of time.
Okay, so if you talk about the manufacturing side of the business, where asset management companies or hedge funds come in, they typically divide into 3 categories. First is what we call as the front office, which essentially comprises of our analysts, fund managers, and traders. Now, these are what we also classify them investment professionals who actually manage money on clients' behalf and generate those returns.
Right.
And then you have the middle office function, which is kind of regulates these functions of compliance and risk management, who act like as doorkeepers for the front office.
So the order and the control of the entire process.
And then is the big back office. All investment firms, whether they're on buy side or sell side, have a huge back office which manages all the operations that happen, which people like you and me probably don't even see. But you would have seen mailers coming on, okay, your trade is now settled, your money has been transferred, this is the NAV of the fund. I mean, there's a huge back office function, which is...
So all the sort of accounting kind of stuff.
Right. It's accounting. It's even very mundane tasks like sending an email to the customer, like your trade is done. So, and generally back office is probably the biggest in terms of people in any investment firm. And technology plays a role in all of these 3 layers that I talked about. It helps in the investment process in terms of idea generation. How do you manage the fund? How do you track investments from a compliance perspective? How do you calculate risk, whether on a real-time basis, on an end-of-day basis, or on a quarterly, yearly review basis? And back office, again, a lot of these functions at the moment are manual. They could be automated. Back office works with regulators, with settlement companies. Everything is there. And technology plays a role in all of that in terms of generating new ideas. How do you process data? All of these stages require data as well as they generate data. Again, technology plays a role in how do you create the best data environment and how best you can utilize data. As we are moving ahead, as complexities grow, like I said, a lot of processes are manual, which increases the operational cost. Technology, again, helps you automate, especially many of these back office operations, which can help you reduce those operational costs and bring in efficiencies. So yeah, technology plays a role in all of these three stages.
That's interesting. You spoke about the processes and how technology helps, but I'm taking from that that probably a lot of this, and you spoke about the idea generation process. And by that, I understand probably you're referring to where this kind of research might be happening, and but that would also implicitly mean that there's probably a lot of need of data, uh, and across these three different functions. And how does how nuanced this is, or what are the complexities? Has the landscape changed because a lot of AI is there, language models are all over the place, chat GPT is like the new Google for most of the people, and not just, maybe it's also a school teacher and a guide and a mentor and whatnot. So talk a little bit about the role of AI and the data specifically within the technology
Okay.
function.
As far as I think, my own perspective, investment management business is essentially data business, right? It's whether you're generating new ideas or managing money on how do you calculate returns, which companies to invest in, it's all data driven, right?
Right.
It's the availability of data, your ability to process the data analytically and generating insights, which helps you decide on your investments. It helps you decide on what kind of controls you want to put in place, and what kind of back office processes you need to automate, and how do you have your KPIs on metrics on that. Just say focusing on the front office, uh, data has always played a key role, uh, whether it was say 25, 30 years back, analysts had to go through balance sheets to generate the how the financial health of a company, uh, see its vendors, suppliers, its customers, building a business model. All of that was based on data. Right now, as and when the internet grew and the use of social media, a huge amount of data that has been generated. What we typically now start referring as unstructured data. A lot of that could be noise, but it's again generating the right information from that, segregating noise and information. Technology plays a role. How do you generate insights from that information? Again, technology plays a role there. Now, like you also talked about AI, I would say there were technologies already available. AI is something not a new concept, but what has now happened in the last few years is the increase in computational power. It's suddenly been brought by the net and the building of these huge cloud computing capabilities by some of these big players. It has helped us process that huge amount of data that is generated in a much faster way and presenting it back to the investment professionals.
Right.
But again, the key thing here is, like I said earlier, again, probably will want to repeat, uh, making a distinction between noise and information,
Yes.
and to ensure the right quality of data. I think now everybody has got access to those technologies. It is people who have the right quality of data on which they make investment decisions, the key in making the right decisions. And this is where I think technology can play a big role in providing the right quality and the right way to present it to back to our investment professionals. I think we're still a far away from where technology can completely 100% start taking investment decisions. But I think it's still people who use AI and these language models in a way which can help them take better investment decisions are the ones I think we're going to succeed in at least in the next few years.
Okay. Okay. That's interesting. So basically, I think purely from a data perspective, you spoke about so many different elements of this, but one of the things is that there's awful lot of talk on, let's say, social media. For example, I was speaking to my sister yesterday on the phone, and she said her washing machine was broken, and she called up the helpline twice. Nobody listened. She said post it on Facebook, right? So everybody is the emotions are coming out, and overwhelming amount of information that's there, but not just the information, but the modalities of how that's presented, the formats in which they're available, as I think they technically call it, structured, unstructured, the videos, etc. So how do you make sense of all of this data? Because you spoke about taking out noise and information, separating them together. How does that really happen? If you give a very simple view of how does somebody know, and if it's so much data, how does it work, how does it come together?
I think for that, we probably will need to understand the very basics of how investment management works, right? There is what we call as fundamental analysis, right? Where you actually want to get into depth of a firm or a company in what you invest in, I would say unstructured data is one other source by which somebody, it could be an analyst, could be even a person like you and me, analyze whether what is the fundamental nature of that business. Even earlier, before the advent of social media, people still used to have news coming in newspapers where things could be said which are very much against that company. Okay, it came with a delay of a day. Now it's almost instant. But I think, what in my experience, the best analysts and the fund managers are those who are able to invest for the long term. Get over that short term bumps. You'll always, in an investment cycle, you won't always get your investment decisions right. But it's people who are able to invest for the long term. Again,
Right.
I want to again give back example of Warren Buffett, right? It's somebody who who is able to overcome their emotions when they're taking investment decisions, right? We are human beings. Although the basic portfolio management theory says every decision is rational, we get all information, but in reality, that is not the case. Our investment decisions are overcome by emotion, and this information generating on social media does add to that emotions. But successful investors are those who are able to overcome that emotion, whether it's happening within them or through the market, and invest for the long term.
Okay, that's very interesting. So I'm going to dive a little bit into what I think we briefly touched upon, but we didn't speak about it like in a structured fashion. The whole process of investment management. I think you spoke about research. You a little bit spoke about the risk involved, the usage of data, where technology plays a role, and so on. But at a very high level, give us like a 50,000 view of what an investment management process looks like. Yeah, I think you spoke about idea generation, back office, but what does this process look like?
Okay, a typical investment cycle starts with research, right? Uh, When research essentially involves a decision which will help you take whether I want to invest in a particular instrument or not. It could be equity, it could be fixed income, it could be anything else. You can do it in multiple ways. You get into the fundamentals of that security or the instrument. You take some help of statistical data and generate some pattern-based investing, or you just run numbers to come out of that decision. And then one of the most key player is what we call as a fund manager or a portfolio manager, who takes really the investment decision whether to buy or sell. So, and that person doesn't just need to take care uh, of a research input he gets, whether it's internal or external. He also needs to take care of cash that he's getting from his customer, because he is the face to the customer. He also needs to maintain money, that if sudden redemptions happen, he can't just be saying, I can't give you money back.
Right.
Once he takes an investment decision to buy or sell, then it comes the role of a trader who actually goes out into the market to buy or sell the stock. In case of buy side firms, you have internal traders who then work with sell side brokers or traders to actually execute those investment decisions in whatever market that security trades on. So this is what is called the front office. And then you have, maybe I'll come to middle office later. First, and then is the back office. Now this back office is where all the action happens when the trading actions happen. There is they need to calculate the value of the security, the settlements, the cash that they have on behalf of the client or on behalf of the fund manager, calculate the NAVs in case of asset management company, publish those NAVs, fund accounting. So all that happens in back office. And then you have middle office functions which kind of serve both this front and back office. They would include a risk function which keep on monitoring every step of the process, whether it's in front office or the back office, both in terms of an individual for protecting the individual investor as well as the investment risk that we are carrying as a firm. Then you have compliance. Now the compliance again can be both external, where they need to ensure the firm or the fund managers are in line with our regulators want, as well as our own internal controls that we want to put in place. And then a key part of this, what you also is becoming very prominent today now, is the data management function, which kind of serves both again the front and the middle office and the back office, who ensures the right quality of data is being made available, as well as ensure the quality of data that is being generated through the process, because a lot of middle office responsibilities also do a lot of reporting.
Right.
The reporting could be regulatory, customer, to our suppliers, vendors. So these are the kind of very in a broad category, 7 or 8 functions which define an investment firm.
Okay. So essentially, this is a place where decisions are being taken to buy or sell so that we can either encash where we have made profits or take better decisions or maybe start writing off bad decisions. And that's typically front office, and the middle office is all about the execution, the settlement, and the day-to-day orchestration of different elements of it, and then all the accounting and stuff is the back office. So that's brilliant. So I think
Sorry, just one more thing I would like to emphasize is I think you hinted earlier, is a lot of, so this is just the investment function. There's a lot of support functions that work along with it.
right.
It could be very simple things like HR or legal. The key function which is now coming in is technology, which again plays a key role across this whole cycle.
Right. And I believe by when you're saying the role that technology is bringing in now is sort of pivoting from just being like a support function to something that kind of gets very organically intertwined with how these actual front office or middle office
Yeah,
functions are.
today I would say technology is almost becoming, it's almost a skill
Yeah.
which all investment professionals, whether they are working in front, middle, or back office, are supposed to have. It's no longer just about a technology is a separate department where somebody comes and starts your PC. No, you need to have that as a skill
Yeah.
if you want to be a
Yes.
good investment professional.
I remember the first job I was offered in one of the Indian PSUs, and that was an IT department. I wanted to be a programmer back then, and then they offered me a job. They said that it's a support function in IT. It's not related to the business. That's how actually I was told.
Like
It's
if
not.
you see about 20, 30 years back, technology used to be reporting many times to the CFO
Yes.
or to
Yes.
the CIO, but today the CTO or the CIO are sitting right on the topmost leadership.
Yes. Part of the board sometimes.
Part
Yes.
of the board. So that's how the importance of technology has become. Typically, if you see many of these fund managers, when they want to invest in a company, they like to interview the CEO, CEO, and the CTO before they take a call.
Yeah, I saw a lot of that in the Shark Tank videos. I randomly watched some of those, and I think one of the questions that was always asked was who's the technology partner.
Yeah.
And I think it has been the case quite a few times that when some of my friends are pitching for to the investors for raising funds, they say there's no point going in there saying that we do not have a strategic technology partner.
Yeah, and I
It's
foresee
just
a
a
very
non-starter.
few years down the line, you might even start seeing CTOs becoming CEOs, which was
Yeah.
a few years back was thought to be impossible, right?
Yes.
Because
Yes.
they are the one now who
Yeah.
are driving the business, frankly.
Well, brilliant. On that note, I think there was a lot of insight into the basics and the overview of the investment management process, who the key players are, what does the process look like, the role of technology, AI. I think in a very brief period, I think we've spoken about a lot of things. And what we would like to do going forward for our audiences, that we would like to continue having these conversations and keep posting it to you on a periodic basis. And what we intend to do as a next step is to take this whole cycle of investment management process and start dismantling the different pieces one by one. So we spoke about the idea generation or research and how the role it plays, and all the way to front to middle and the back office. So we'll start with the first stage of the investment management process, which is research, and then we will talk about the different asset classes on which we briefly touched today. Whether it's equities, private equity, and so on. What role does research play, and what are the different stages that are sort of part of the process, and so forth. If you have any comments on this one, let us know. And if you want to reach us, I think Amit's email will be there in the bottom of the video. So please reach out to him directly, or if you want to post a comments on the video, feel free to do that and ask as many questions. And if you're working in this domain or want to know about specific areas, please write down that in the comments, and we'll try to incorporate as many questions as possible in the coming up videos. Thank you very much, Amit. Very
Thanks,
useful
Ashutosh.
conversation. Thank you.